Hello, welcome to week 7 of the discussion. Today I'm going to talk about process of business valuation. So business valuation is a process to determine the economic value of a business and its components. It's often used as mergers, acquisitions, investment analysis, financial reporting and strategic planning. I'd like to explain step by step the different process involved in the evaluation. So the first one is to define the purpose of valuation. And here is where we identify why the valuation is being conducted and what is the purpose that will influence our choice of valuation method. There are different purposes which can include on a common note, which are the sales of the business, fundraising, and tax planning. Understanding the business. So this is where performing a thorough analysis of the business will come into picture. The first one is industry and market context, analyzing different industry trends, competitive position, and market growth. The second one is operational, wherein we understand the different business models, key products, and services. The third one is the financials, wherein we review our historical and project financial performance, which includes revenue, cost, margins, and cash flows. The last but not the least is the management and workforce, which will assess the team's capacity and capability on their impact on the business. Then we gather the financial information, which will collect all the relevant of the financial data. This will include the main subject lines as income statements, balance sheets, and cash flow statements for a couple of years for to be able to give to our data and financial analyst. Then they thorough and get the details of all the assets and liabilities for the past few years. They perform all these projections on the future performance, and a few of the non-financial metrics can include customer retention rate and market share. Choosing the appropriate valuation method is as important as understanding the nature of the business between the different products and services and different industries. So, market approach is one such important thing when we compare the business to any similar company in the market based on some metrics like price to earnings or EBITDA ratios. The income approach is a project-based future cash flows and the discount then to present value using an appropriate discount rate. Capitalization of earnings will discuss about estimating the business value based on its expected earnings and a capitalization rate. Asset-based approach will include its net asset value, liquidation value to estimate net proceeds if the business was sold off. Then, once we gather all these information, we perform the valuation. Using these selective methods to calculate the business value, we use multiple methods to arrive at a final estimate. The key steps will include adjusting financials to remove one-time or non-recurring items, determining the appropriate multiples and discount rates, considering intangible assets like brand value and patents. Then comes the conducting of risk analysis, which will evaluate the risk on its effect of the business value, such as market competition, regulatory challenges, financial stability, and dependency on key customer or suppliers. These incorporating these risks into the valuation is often really important by adjusting the discount rates or cash flow projections. So preparing the financial report is also a potential part of evaluating because it's always the valuation report which can be published to the hierarchy of managers or whoever is the business owner to summarize all your findings in a clear and comprehensive way and to define what the purpose and the scope of the valuation is, and going on through the overview of each risk analysis and assessments the data and financial analysts have been doing, explaining what and why we choose different valuation methods and what are the different key metrics and key key assumptions, inputs, and what are the outputs we are planning to get into, and of course the final valuation result at with which includes the sensitivity analysis. So engaging stakeholders to review the valuation, as I mentioned before, is really important for legal and regulatory purposes. It may also require few involvements of third-party vendors and experts or auditors and their sign-off on each of your uh, the reviewing documents is also very vital when evaluating. Some of the key considerations which every business should follow is accuracy of the data, ensuring all the financial data and assumptions are very accurate and close to realistic. One of the professional expertise is also depending on the complexity on hiring different experts to be able to do this valuation, and also following the compliance regulatory, ensuring all the valuation adheres to all the relevant legals and tax regulations. The process of the business valuation extends beyond those technical methodologies to include broader considerations such as social responsibility, government regulations, balance between the shareholders' wealth and meeting the shareholders' interest. Here is some in-depth analysis I would want to discuss where there are interconnected dimensions. So the different valuation methods will include asset-based, market-based, income-based. Asset-based is something which is focused on the value of the business assets minus the liabilities. One example is appropriate business with substantial tangible assets on its liquidation scenario. The market-based approach is using when there is sufficient market data on comparable business, and the income-based approach is dealing the business with steady cash flow and growth potentials. The role of the ethics and social responsibilities in business value is also really crucial to ensure the valuations reflection on non-financial outcomes, which includes transparency and integrity, environmental factors, the long-term impact, and the social factors. The impact of government regulations on the evaluations will be by creating both constraints and opportunities such as compliance cost, regulatory risk, taxation, industry specific rules, etc. And maximizing the shareholders' wealth versus the stakeholder interest um, is by complementary or conflicting ideologies or approaches, which is sustainability leads to value of creation when the business that prioritizes social responsibility and environmental sustainability can attract customers and investors, enhancing these long-term share wealth, wherein conflicting goals are the efforts to maximize shareholders' wealth in the short term, such as cost cutting, dividend increases, may harm employees and reduce the product quality. Integrating the interconnected dimensions can be achieved by ethical values and practices, ensuring there is accuracy, transparency, and fairness to the valuation methods. ESG integration to incorporate environmental and social risks, regulatory awareness to stay updated on relevant regulations. Balanced objectives will focus on sustainable strategies to align with shareholder wealth maximization. To conclude, the valuation process must consider not only financial metrics but also a broader ethical social values and creating that regulatory environment. By recognizing all these interconnected connectors of these factors, business can arrive at a valuation that is not only fair but also accurate, sustainable, and responsible. This balance will definitely foster trust among the stakeholders, shareholders, and contributors to long term value creation. Thank you.